African countries are exploring ways to reduce dependence on the US dollar for trade, a move driving the rollout of the Pan-African Payment and Settlement System, PAPS. The initiative, supported by AFTA, stakeholders aim to allow seamless trade across the continent in local currencies, cutting costs and boosting intra-African commerce.
There is need for financial institutions to onboard the Pan-African payment system to reduce pressure on individual country currency as well as grow trade at a faster rate.
Something that could shake the entire global financial system. Japan, the world's most indebted advanced economy, just triggered a bond market explosion that has investors scrambling. A massive stimulus package that makes no sense. A currency behaving like it's from an emerging market, not a G7 powerhouse. And wait until you hear what this means for the United States and your wallet. Plus,
over 50 years, Japan has been America's most loyal financial partner. While China gets all the headlines, Japan quietly holds over $1.18 trillion in U.S. Treasury securities, making them the largest foreign holder of American debt. That's more than China, more than the UK, more than any other nation on Earth. But here's what makes Japan truly dangerous to the dollar system. They're not just holding our debt. For decades, Japanese investors have been borrowing yen at near zero interest rates and are using that cheap money to flood into American assets.
All right, a growing conversation is emerging across the continent about whether African capital markets can truly create wealth for Africans and expand real financial inclusion. Policymakers, asset owners, entrepreneurs, financial professionals gathered in a panel to examine how a shift in mindset towards saving, investing, and local ownership could unlock greater economic participation. Let's take some excerpts from the panel.
The news broke before sunrise, carried first through quiet financial terminals in Tokyo, then ricocheting across Africa's rapidly expanding economic networks, and finally exploding across the screens of Wall Street traders who had no idea their entire week, their entire year had just been turned upside down. Japan and Africa had just pulled off a financial maneuver so coordinated, so calculated, and so astonishingly bold that America's economic analysts were left blinking in disbelief. This wasn't a typical trade announcement. This wasn't a routine investment partnership. This was an unprecedented money move executed in absolute secrecy, designed to shift financial gravity away from the United States and toward a new axis stretching from Tokyo to Nairobi, Lagos, Johannesburg, and Cairo. It began with whispers about a massive liquidity pool, one that Japan had been quietly building outside the eye of Western markets. But what no one expected was that the pool wasn't being prepared for Asia, it was being merged with Africa's newest sovereign wealth platforms in a move that almost no economist had predicted. Overnight, the partnership became the largest coordinated investment bloc outside the U.S. financial system, and Wall Street instantly understood the danger. The United States had built its financial dominance on being the center, the place where capital flowed to and from, the place where deals were cleared, approved, and validated. But now Japan and Africa had created their own ecosystem, and they weren't just participating in global finance. They were rewriting it. Africa's central banks had already been discussing alternatives to US-controlled financial rails for years. A continent tired of dollar dependency, tired of currency vulnerability, tired of decisions in Washington dictating outcomes thousands of miles away. But those efforts had always been fragmented, slowed by internal divisions and pressure from American institutions. Japan changed that overnight. Its involvement unified Africa's negotiations, silenced internal hesitation, and provided the technology backbone needed to build a financial network completely outside American oversight. And when the announcement finally dropped revealing the creation of a new multi-continent clearing system, investment alliance, and commodity-backed reserve asset, the shock was immediate. America wasn't just surprised. America was blindsided. The first tremors hit Wall Street minutes after the announcement. Futures markets dipped as traders struggled to understand what the shift meant. Analysts scrambled to reprice portfolios, desperately trying to estimate the scale of the move. But the unknowns were too large. The financial system was too dependent on U.S. dominance. And now, for the first time in living memory, another power bloc had emerged, a bloc with the liquidity of Japan and the raw resources of Africa, combined into a single strategic engine. The United States watched as African countries announced that some of their raw materials, including gold, rare earth minerals, cobalt, uranium, and lithium, would now be priced and traded within the new Japan-Africa financial structure rather than through U.S. markets. The implications were seismic. Commodities that American companies relied on for electronics, cars, aerospace, and renewable energy technologies were suddenly moving through a system Washington did not control. Within hours, the White House convened emergency meetings. Advisors argued over whether the Japan-Africa alliance was intended as a direct challenge or simply a restructuring of global finance. But the markets were already reacting. The US dollar slipped against the yen, Africa's currencies spiked in value, commodity prices became unpredictable. US investors who dismissed Africa for decades now stared at screens showing numbers they didn't believe. Japan's role wasn't purely economic, it was strategic. For years, the country had been quietly investing in Africa's transportation networks, manufacturing zones, and renewable energy grids. Now those investments had matured, forming the backbone of a financial shift that America had failed to anticipate. The alliance wasn't built overnight. It was engineered slowly, carefully, under the radar of Western media until the architecture was strong enough to stand on its own. Africa's leaders celebrated the partnership as a historic moment. At last, a major global power had chosen cooperation instead of extraction, partnership instead of paternalism. Japan emphasized respect, equality, and shared growth, and Africa responded with levels of trust no other major power had earned in decades. This trust became the foundation of a system designed to protect Africa's interests while giving Japan access to markets and resources without political interference. America, however, saw something different, not an economic partnership but a financial rebellion. Wall Street banks issued urgent reports comparing the shift to the early days of the euro, warning that a new global reserve asset could destabilize the dollar's dominance. Hedge funds scrambled to reduce exposure to U.S. manufacturing firms dependent on African supply lines. Media outlets speculated whether the partnership signaled the beginning of a new global economic order. What shocked America most was the confidence with which Africa moved. Gone were the days of waiting for Western approval, waiting for IMF guidance, waiting for permission to restructure its financial destiny. Africa had chosen its partner, made its move, and executed it flawlessly, and the message was clear. The continent was no longer an observer in global economics, it was a player. Japan's prime minister made one statement that echoed across the world: Asia and Africa will build the future together. It was a simple sentence, but one that struck at the core of U.S. influence. For decades, America built its global strategy around ensuring no other alliances grew strong enough to challenge its economic power. Now, in a single coordinated move, Japan and Africa had created exactly that: a unified financial front capable of reshaping supply chains, shifting commodity flows, and redefining investment priorities. And the U.S. could do nothing but watch. The new system was already live, the money had already moved, the alliances were already signed. What came next would not only affect America's markets, it would transform the global economic landscape forever. The world had entered a new era, and the shockwaves were only beginning. The second wave of shock hit the United States not through Wall Street, but through the industries that depended most on African resources. In Silicon Valley, engineers and executives watched as procurement teams panicked, realizing that the Japan-Africa alliance had rewritten the rules of access overnight. No more automatic contracts. No more privileged pricing, no more American dominance in negotiations. The balance had shifted, and every company from smartphone manufacturers to electric vehicle giants could feel it. For years, U.S. corporations assumed Africa was merely a supply ground, a place to extract resources while offering little in return. But now those same corporations were frantically calculating how many months of inventory they had left, how quickly prices would spike, and whether Japan's involvement meant they would soon be forced to compete on terms they could not control. Japan, meanwhile, moved with methodical precision. Its financial institutions activated digital infrastructure designed for scalability, enabling African countries to transfer commodities, settle payments, and issue cross-border financing with unprecedented speed. What stunned analysts most was the technological integration. Japan had provided Africa with blockchain-backed systems that eliminated the inefficiencies of Western-controlled platforms. Transactions that once required American intermediaries were now instantaneous. Africa's resource-rich regions quickly realized the power they now held. By aligning with Japan, they had gained leverage never experienced before. Their minerals were no longer undervalued due to Western price setting. Their markets were no longer treated as secondary. Their currencies were entering a stabilization phase as the alliance boosted continental confidence. Even countries outside the core alliance began signaling interest, sensing a once-in-a-century opportunity to reshape their economic destinies. America attempted to respond diplomatically. High-level officials requested talks with Tokyo, seeking clarification on the alliance's long-term plans. Japan responded with polite neutrality, insisting that the partnership was about shared development, not geopolitical rivalry. But behind closed doors, U.S. advisors knew the truth. Japan had made a calculated move to break away from the limitations of Western-led financial structures. It had chosen a path where Asia and Africa could thrive without American oversight. The United States was particularly unsettled by the alliance's decision to price certain African minerals in the new reserve asset. This meant fewer commodities flowing through U.S. dollars, fewer opportunities for American banks to skim value, and fewer channels for Washington to exert influence. The ripple effect spread quickly. Nations in South America and Southeast Asia began discussing similar alternatives, citing the Japan-Africa model as proof that the world was no longer obligated to operate within U.S.-centric systems. In response, U.S. media launched a wave of criticism, questioning the stability of the alliance and warning of potential risks associated with abandoning Western-backed financial norms. But Africa dismissed these narratives with confidence. After decades of enduring unequal agreements, punitive lending conditions, and strategic resource manipulation, the continent was finally writing its own rules. Japan's partnership was not seen as a replacement for American relationships, but as liberation from dependency. Economic think tanks in Europe struggled to interpret the move. Some argued that Japan was positioning itself for long-term competition with China by securing African partnerships before anyone else. Others noted that Africa's rise was accelerating faster than predicted and that the world was witnessing the emergence of a new global power bloc. For the first time, Africa was not being discussed as a continent waiting for development, but as a continent shaping development. Back in the United States, internal pressure mounted. Corporate leaders demanded that the government respond more aggressively. They warned that losing influence over Africa's raw material markets would harm U.S. manufacturing competitiveness for decades. However, policymakers were split. Some favored negotiating directly with African nations, offering new deals to regain access. Others argued for sanctions or restrictions, unaware that such tactics would only push Africa further away. The most striking development came when Japan and Africa collectively unveiled a new investment fund designed to support infrastructure, technology, and industrial development within African countries using their own currencies and financial systems. The fund was 10 times larger than any U.S. development initiative offered in recent years. More importantly, it bypassed the conditionalities that had historically constrained Africa's growth. This gesture cemented the alliance, proving to African nations that Japan was committed to long-term mutual benefit, not short-term profit. As the hours passed, it became clear that this was not a temporary disruption. The global financial architecture had been fractured, and the fracture favored a future where Africa and Asia would command far greater influence than before. Wall Street analysts revised their forecasts, economists recalculated global growth projections, and geopolitical strategists warned that America was entering a period of weakened leverage as the world diversified away from its institutions. The Japan-Africa money move was more than a financial surprise. It was a signal, a declaration that global power would no longer be defined solely by Washington, London, or Brussels. It was a reminder that alliances built on respect, transparency, and equal opportunity could overturn decades of economic dominance. And as night fell, in the United States, one fact became undeniable. America had just witnessed the emergence of a new global alliance, one strong enough, unified enough, and strategic enough to reshape the world's financial future, leaving Washington scrambling to catch up.